All right, testing 1, 2, a little bit behind schedule today, but we're getting back into the swing of things. Let me know when you guys can hear me and we can move this puppy forward. Let's see, I'm tired today. I woke up way too early. Woke up like 2:30, could not go back to sleep. So I'm now up 11 hours. All right, people seem to be able to hear, so I'm going to put the video on in a second. First, I got to get this other thing running. Some behind the scenes work being done. So we got the Fed up soon. Got their meeting goes on at 2:30 or something like that. How do I find CNBC on this thing? Not that. Huh. All right, hang on 1 second. Let's see. Because Bernanke's speaking there, I won't have the TV ready, so I can at least see what he's saying. All right, things look good there. We're going to try the screen sharing thing. Tell me when you can see something interesting. La-di-da. Kind of flat, been kind of flat all week. All right, everything seems to be functioning properly, so let's see if we can get this thing started. La 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 la, there we go. And go.
Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither, nor its affiliates, nor any of their respective officers, personnel, representatives, agents, or independent contractors are in such capacity.
What the heck was that? Holy cow, it crapped out. That's pretty weird. Telling you, too much faith in technology is the problem.
Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither PhilStockWorld.com, nor its affiliates, nor any of their respective officers, personnel, or representatives, agents, or independent contractors are in such capacity as licensed financial advisors, investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Visit the OC website. Trade characteristics and risks of standardized options. PSW provides education and training services that are meant to teach you the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on a specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any loss you may incur as a result of information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your briefing very seriously, and we will not distribute or sell your information to anyone. You
You know what? Listening to the way that thing translates, I'm not too worried about them confidently distributing information because they don't seem to have a handle on that. So let's see. It is the Dow's down a little bit, S&P's flat, Nasdaq's down a little bit. Nothing exciting going on really. Oil's up a good bit. That EIA report come out. Let's see. La 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 la. Da, da, da. It's funny thinking about all the things we talk about in a week, right? It's like, look at all that crap we were saying. Here's the Fed, that's going to be important later. Here's the EIA, I knew I had it somewhere. April 23rd, fantastic. What happened? Import 6.6 million barrels, huge increase in imports. Look at that. That's interesting. Over the past 4 weeks, something in my throat. Over the past 4 weeks, crude imports averaged about 6 million barrels per day, 10 more than the same 4-week period last year. Motor gasoline imports average 1 million, distillate average. All right, commercial crude. Very tiny increase in total crude supply. Gasoline inventories increased by a very tiny amount also. And distillate decreased by 3.3 million barrels. So on the whole, it's a net draw of 3-something million barrels. So, and you can see that right here, 1923 goes down to 1920. So let's see what we have here. This is interesting though. We have imported oil, 2983 went up to 3.2, so that's up about 300,000 barrels. Exports went up a little bit too, up to 100,000 barrels, but not much of a change. Not really anything exciting here in this report, but there's no build in supply. We actually have a drawdown in distillates. So, excuse me, so it's structurally supportive for oil, and that means that we can get this. Nice, well, that's very long term. Been having a general bounce back up from 61 at the low, came back to 64, almost testing 65. 67.50 is the normal resistance that you'd expect on Brent. Gasoline went flying over $2. Somebody asked me yesterday if we should short gasoline $2. I was like, that's way too dangerous when you're coming into May, which is the summer driving season. And what happens to gasoline in the summer? Let's take a longer look. So here's last May. See April, May? Look what happens. Here's your holiday weekend, right? Somewhere around here is your holiday weekend. And then you got the July 4th, and that's usually where you peak out for the year. But last year was weird, of course, but in any given year, that's a pretty normal seasonal thing. I don't know if you can be able to see on a weekly. But here's 2019. See, here's April, May, right? And I don't know if that's June or July, but something, whatever happened here. But you know, this is the time of year when you have a very good chance of going up. Here's again, March, April, May. In this case, we had a downy thing. Oh, that's May. Here's April. For whatever reason, we went down there. So, okay, it doesn't really make a pattern. But here you go, March. Here's more normal March, April. That's what you expect to see, March, April, May. And then you might come down, then you get usually July 4th-ish, you're going to get another kind of pop. See up here, you can tell that obviously we peaked out in July and came down considerably. So, you know, we don't really like to short just as a percentage play. There's, you know, oil, there's no major fundamental things moving oil. So what's going to move oil is really going to be just sentiment. And the sentiment when you come into the busier summer driving season, when you talk about everybody reopening and travel restrictions being lifted and so on and so forth, well, then it doesn't make any sense to short it, does it? So, you know, just leave it alone. It's not a good time to play it. There's no obvious play here. Hopefully, I mean, frankly, right now, we would hope to see it go up and up and up That's gasoline, not oil. But, you know, we would like to see oil just continue to go higher and test out the 70s, because then we're going to feel really happy about shorting it into the fall. You know, but you have to learn to not play things. That's the key. If you don't have any particularly good reason to play it one way or another, then just don't play it. And look how, by the way, look how thin the trading was last year. Look at that super low volume. Oh, hang on a second. Hi, Jackie.
Hi,
How's it going?
it's going pretty good. Guess what I'm doing right now?
Well, hang on. Before you tell me, it might be bad. Just say hi to America.
Oh no, are you in a conference call?
It's my webinar, sweetie.
I'm sorry.
Say hi, everybody.
Hi, everyone. I'll talk to you later because we need to talk about apartment stuff.
Oh, okay.
That's like a very big possibility.
All right. I'll talk to you later then.
All right.
All right. Love you, sweetie. Bye. All right. There we go. So, what was I talking about? Oil, blah, blah, blah. Oh, the volume. Yeah. Look how little trading there was. That's incredible, right? That's like, here's normal is, I mean, for whatever sake, this is, it's a roundabout here, 6, 5, 6, whatever. Here we're looking at 3. So almost half volume. And we're still not back yet. Now, what does that mean? It doesn't mean a lot, but you know how I feel about low volume rallies. So to some extent, we've had a very low volume rally. It hasn't improved very much yet, but you know, also there's been a low volume of actual oil to trade. We've really had a tremendous cutback in consumption and production. So, you know, you can't really expect the past to repeat itself here. Everything's different. You know, we don't know when it's going to get back to normal, but what we do know is there's a lot of upside catalysts. There's not really any downside catalysts right now. So it's a bad time to play. Certainly a bad time to short. I wouldn't go long either though, because we're too toppy. Here, yeah, of course. You know, here you can go long. Here it's a little too late. So we'll see where it ends up. And in July, we're probably going to have some more interest in shorting again, but that'll depend on what happens between now and July, of course. How about the index? What does that look like on that view? Woohoo! Look at that. So also peaky. These are really, look at that. If they made a roof here, it broke. Then they make a roof here and it broke. I don't know if this goes up again from here. I give up. I just, you know, I think we just have to just go long. We did just go long, didn't we? Though we did a bull call spread because I said this thing that I think last week we did a bull call spread. We said this thing's never going to stop going up. You know, so we wanted to hedge in the short-term portfolio. We wanted to hedge on just to make some more money on the constant uptrend. So the NASDAQ may be topping out at 14. Who knows? Hard to say. And the Russell, just way the frick up there. These are insane levels. I mean, you know, it's fine to be enthusiastic, but this is way beyond enthusiasm. Here's the Nikkei, Japan, 250% of their GDP in debt, hitting 30,000. That would have been a good shorting spot, right? We weren't paying attention to that. Hitting 30,000, went over 30,000, but that's a great spot to short. You have a run from 20,000 to 30,000, and you can be pretty darn sure that you're going to get at least a 20% pullback, which would be 28,000. That's a week retrace is 28,000. Now you can be pretty damn sure you're going to see that 28,000 line. And especially because you've had absolutely no consolidation at all since 24. So 24 to 30 is 6, and a strong retrace of 6 is still below 28, right? It'd be 120 plus 120 is 240. So a strong replace from the last consolidation and a weak retrace of the longer run is clearly going to take you back to 28,000. And you can see it already happened. I mean, you got a rejection here, it came back down, went back up, probably going to test here, might break lower though at this point, might go back down 2750, even 26. And interestingly, 26, you're almost back on track, right? 26 is almost like a normal progression if this year hadn't been so screwed up, we might have normally progressed to 26 and nobody would have thought twice about it. So, you know, that's kind of something you might be able to say could happen. How's Europe looking? Europe's also blast off. The DAX, and again, oh, here's another one. The Euro stock's at 4,000. These are a lot of really, really hard points to get over. So there's a lot of resistance being hit here. The DAX, I guess 15,000 is probably a line on the DAX. TST, here's 10,000, right? Good bottom. So how's 12.5 look? See, if 10 and 15 are significant, then 12.5 should look like something. So 12.5, yeah, you can see along this line here. See, it was certainly something there, and it was something around here too. And I wouldn't say it was really holding up here, but it was, you know, I guess you can make a case for 12.5 mattering. Certainly mattered here for these two candles. Look at these things, really on that 12.5 line. All right, I'd have to give 12.5 reason. I'd say it's reasonable. And reasonable enough to say, I mean, obviously 10, you know, 10 doesn't really hold either. You can just see like 10 is a good spot here. See, when you say something's, when something's resistance, doesn't mean you're not going to go above it, doesn't mean you're not going to go below it. It just means that you're going to hover around those points of resistance. And you could obviously make an argument for lots of places. But again, back to the 5% rule, the 5% rule tells you that 10,000 is a lot more likely to be the spot than 11,000 is. Even though 11,000 from a chart point of view looks like you could make a pretty strong case for it there. But anyway, and if you're not sure, you split the difference, say 10.5, whatever. But you know, either way, I'd call it 5,000. And if it's 5,000, that means you got a 1,000 point retrace. So on the DAX, you're going to be looking for 14,000. And the VIX is having fun. The VIX is trying to hold on to that 20 line. We'll see if we can keep the volatility going. Steve says, last week near the end of the webinar, you explained the 5% rule based off points of consolidation. Oh, well, we were just talking about that. I see many people use Fibonacci lines instead of the 5% lines. How did you learn that 5% lines are better predictors than the fibs? Aha. Oh, you know, in our education section, we have some articles that address this. Let's see, education. Oh, I see. Educational archive. Okay, meanwhile, you guys should be reading these educational archives, by the way, because look what we got here. How to Get Rich Slowly, that's a classic. Look, I haven't updated these since 2015. You know what it is? I hate to write something I already wrote. So it's like, you know, I know a lot of people rewrite the same articles over and over again. I hate that. It's like I wrote it. I said what I wanted to say 5 years ago, so, or more than 5 years ago. How to make $100,000 in 12 months trading stocks. I mean, you know, these don't have to be current. These are our strategies. Using options to pay yourself monthly dividends. How to Get Rich Slowly. We have a video of that. 7 steps to 40% returns. We have a thing. An article on rational debating. I should have wrote that one back out for the Trump era. Rolling contracts. Wow, these are some good articles, man. Oh, here you go. Charts from the Future, 5% rule update. That's an important one. And I had one specifically about Fibonacci. I wonder if the microwave oven theory of behavior, one of the most important economic theories of our time. 7 steps again. See, back then I used to do things twice. Let's see. Oh, stupid options tricks. That's in our strategy section also. That's a very important article. Vacation proofing your portfolio. I don't know why we have a portfolio update in here. Oh, that's it. So those are education articles. what I was thinking of was PhilStockWorld. Fibonacci rules. Aha, I knew I had a specific article about that. So here you go. This basically, instead of me talking, this answers your question. And it's called Fibonacci Rules. Sometimes the old ways are the best. And I talk about the 5% rule, and I talk about the Fibonacci and how they are actually related. The Fibonacci rule is not some TA thing. It's actual science. It's not really understood science, but there's a certain pattern to expansion and contraction. And if you observe it over large amounts, large scale, it's like statistical analysis. There's a certain, in most things that grow naturally, they will expand and stop or contract or consolidate at certain points. And that's what the Fibonacci series is about, is telling you where these things happen and how things progress. The 5% rule is similar, but the difference is the 5% rule takes into account something Fibonacci doesn't, and that's that people aren't trading. See, when Fibonacci rules came about for trading, it was when people used to trade, and people follow a more natural pattern. But since the 90s, basically, there's been more and more computer trading, to the point now where probably 80 to 90% of the market trades are done by computer programs. Computer programs follow their own internal mechanism, and that's where the 5% rule comes from. It comes from something I observed. My father was a systems analyst, and we used to do consulting on Wall Street. And I used to go along. I know very, very little about actual programming, but I do know Wall Street. So when I was younger, my dad's consulting company, when he had Wall Street jobs, he would bring me along, and I would translate. Basically, I would translate the programmers. I would translate for the programmers to the Wall Street guys, and I would translate what the Wall Street guys wanted to the programmers, because neither one of them understood each other for shit. These days, I guess things are probably better. But the bottom line is, in sitting in many, many meetings with many, many different major Wall Street firms and watching them design their programs, I realized that no matter how unique and different they think they want their system to be, they're all going to follow certain principles of human behavior and certain principles of computer behavior that end up converging at certain points. And those points tend to be 5% lines. And that's because of people's tendency, even programmers' tendency, to round things off. So when you say, when would you like to start selling? Somebody doesn't say, I want to start selling at 63.2%. No. They say, when we get to 80%, we're going to start selling. When we get to 60%, we're going to start selling. We're going to sell one. And when we get to 60%, we're going to sell 1/3. Right? They don't sell 28.6% at 66%. People don't think that way and don't talk that way. And even if you tell a programmer that, they'll go, oh, that's silly. Let's just do 30%. So in all these different little rounding here, rounding there, and also the fact that people don't understand that numbers are not truly random. That's another problem people have. They think there's such a thing as a random number. There are no such things as random numbers. Random numbers are generated by another program. There's a program that was written to generate a random number. It's not really random. It's just that it seems random to you. Hang on, let's listen to the education section, because it should be. So education. There it is. Haha. Anyway, so that's what the 5% rule takes that into account, but it is actually based on the same concept as the Fibonacci retracements, except we're applying it to the real situation of how trading actually works. And there's the guy. That's Fibonacci. He's cool. Had a hoodie. He was the first guy to wear a hoodie. That's his claim to fame. So anyway, so the gist of that is it is very similar, and the Fibonacci lines came first because Originally, you were applying, and it worked because you're applying the Fibonacci number sequences to human behavior, and human behavior in masses, buying and selling stocks, is going to fall into that natural rhythm. But when you introduce computers, you break the natural cycle and you move into a different cycle. And the more things are program traded now, these days, there's nothing but the 5% rule. When we first started doing it almost 20 years ago, and we started talking about the 5% rule and how it worked, human trading was still almost half of the market. There's no more human trading. I mean, we're a bunch of weirdos. We actually trade our own accounts. I mean, we're such a dying breed of people who actually do trade and trade their own accounts and make their own decisions. It's a rarity. And the more people do that, the more they obey these things, the more you see that we fall into these patterns. So it becomes the 5% rule becomes more and more accurate. And it is scary how accurate it is. But of course, recently, the S&P, hang on, I have a stock chart. Oh no, this is probably horribly out of date. But let's see. I haven't updated my S&P chart in a while, so I don't know what it's going to look like. Yeah, it doesn't look like anything. So, well, I mean, it does actually. Here's the 40% line. What? Shit. I don't know why that 40% thing is over there. Now I got to do the math. Okay, let's see. So 2850 is our base. 2850 times 1.35. 3847. Yeah, there you go. Bingo. So I'm sure that this is the right level over here. So 2850 times 1.4 is 3990. Okay, so there you go. So for whatever reason, they should be down here. So then clearly we're more like, if that's 35 and that's 40, that means we're at like the 45% line. 2850 times 1.45. What? 2850 times 1.45. 4132. So as you can see, 4132, which is down here actually. And isn't that funny? See how that works? See how this line is actually being obeyed? So 4132 is the, well, what do we say that was? So 1.45% line. So the range we're in now is 1.45 to 1.5. Just because, now again, we talked about this several times. We haven't officially adjusted the line, and it would change a lot of things. But 2850 is the base value of the S&P as of 2 years ago. We haven't recalculated in a very long time. Mostly because it's been warped. Usually sometime last year we would have recalculated. We calculate every 2 years, because it's very tedious to go through all these companies. You can't tell right now because of all the stimulus and all the, some companies are doing badly because of the COVID. Some companies are doing fantastically because of the COVID plus the stimulus and whatever and the relief they get. It's very hard to say who's really doing good and who's really doing badly and what the real earnings power is of a company. Also, the Trump tax cut screwed everything up because you're not dealing with the same tax rates you were dealing with before. And now Biden's putting them back to God knows what. So it becomes extremely hard to figure out what the actual earnings power of these companies are. I do know that before Trump took office, or no, I'm sorry, it was even after Trump took office. But but in other words, in the middle of Trump's term, accounting for the tax breaks, we came up with 2850. And that's the base. That's the must-hold line for the market. That's the lowest rung where we would be buying like crazy. Now, of course, you're not going to get back to 2850 now because the tax breaks alone added 10% to the earnings power of the companies. So that means your base goes from 2850 times 1.1 is 3135. Now, in addition to that, you've got the stimulus, okay? $6 trillion last year of stimulus, another $6 trillion this year. That's 30% of our GDP in stimulus. So that right there is going to add 20% to corporate earnings. And now you're at 3,762. So now your base is around here. Well, all right, so here's 3,762 is down here. So your base is now up here. And we're still over that though, but at least we know the base should be around here, this line. So roughly the 35% line is really where we don't expect to fall much lower than, unless we unwind the tax cuts and we unwind the stimulus, and the Fed, of course, does theirs, and the Fed comes into play also. There's just way too many factors making life just way too easy for companies right now. Will that continue forever? No, it will not. At some point, you're going to have to pay the piper, although modern monetary theory says maybe not. Maybe we never have to pay the piper. Maybe there's no piper to pay. If Peter Piper doesn't pay the pickled pepper, where's the piper Peter Piper has to pay? It's hard to say. And by the way, look at this. So look how beautiful this thing is. I mean, look at these. You know, here's your lower line. You go up here, you fail, you come down here, you double fall to the next level, come back up, touch this again, come back down, touch that again. This thing works. The trick is to figure out what zone you're actually in. And like I said, so even though the level has changed, the base is the base. You can't change the fact that 2850 was the base at some point. Now it's a question of saying, how much are we going to give them plus 2850 to account for these new paradigms that we have, to account for companies now paying much less tax, therefore more money drops to the bottom line. Company didn't do anything better. Company didn't improve. Nothing went good. The economy didn't get bigger, you know, not obviously marginally, but I'm saying not to justify where they are. What happened is we changed the rules. You don't have to pay taxes anymore. That's the new rule. Therefore, more money. That changes the paradigm of how these companies work. By the way, this capital gains tax thing, I don't know if it's going to affect dividends, but you have to think about that is, you know, when you've got a stock and people want them for capital gains, will those fall out of favor, and will dividend stocks become more popular? Will stocks start paying bigger dividends now to attract investors? Because the growth of the stock will no longer be attractive if your dividends are still 15% and taxed at 15%, and but capital gains, long-term capital gains, start getting taxed at 40%. Then why the hell would I want long-term capital gains? That's where, are we done with this? I think we're done with that discussion. So that's where, you know, a company like AT&T, for example, well, it's not going to look like that now. But yeah, I mean, look, AT&T, I did a video about AT&T and the Be the House, Not the Gambler video. AT&T is our example. It was at $30 10 years ago, or however many years ago that was. It's always at $30. Why is it always at $30? AT&T is always at $30 because AT&T, where are you? AT&T pays a 6% dividend. They pay $2 per share in dividends. Financials, I'm just going to say so somewhere. Cash flow. Debt, expenditure, interest. What? I should say so somewhere. Balance sheet. Somebody's got to talk about that. Ordinary shares, tangible debt. What? God damn it. Somewhere it should say how much dividend they're paying out. It's a lot of money anyway. I just don't know what's going on here. All right, how about here? You know, the internet was supposed to make all this stuff. Oh, here you go, dividend. Oh, that doesn't help. I want to know the actual number. Really pissed me off. All right, anyway, so AT&T pays $2. Look how steady that is. Two. AT&T pays $2 a share in dividends. Well, the earnings per share. Well, there you go. There's a good thing. The EPS is not even $2. Could be more. But basically, the EPS is $2 a share. They're paying $2 a share in dividends. They're paying all their earnings in dividends, basically. Right? $2 a share, $2 a share, $2 a share, $2 a share, $2 a share. Even going forward, they're going to be paying less, like 2/3 of their earnings. So they actually got $1 a share to play with. But the point is, that's their growth. Okay, they're not investing all. They're investing some money in growth, but basically they're just paying out dividends. This stock just pays out dividends. It's not there to grow. It's not looking to go from 30 to 60. They're taking all their profits and redistributing it back to the shareholders. That's what dividend companies do. Now, God bless them though, because frankly, I would rather, if I'm paying 15% tax on my dividends and I'm paying 40% tax on my growth, I would rather get the dividends, please. I don't need the stock to go from 30 to 40 to 50. I would rather collect. In other words, if the stock goes to 50 over 10 years, right? So if the stock goes to 50, I pay. So I'm going to pay tax on $20 of growth times. Well, obviously it's 8. So I'm going to pay $8 in tax per share for the growth. But if the stock instead pays me $2 of dividends for 10 years, it's the same 20, and I'm going to pay $3 in taxes at 15%. So $5 more cash goes into my account by taking the dividend rather than the growth. And people don't understand that about dividend stocks. It's like, you have to take that stuff into account. And that's why dividend portfolios are so wonderful. Of course, long-term capital gains are good too, but if they're going to take that away from us, then we have to be a little bit more clever with our investing. We're going to have to change some of our strategies. What else? All right, let's see if we've got questions. Nope. Okay, no extra questions. So good. Where was I? So yeah, this, by the way, this is huge. I mean, $2 dividend from AT&T. When you're paying $30 for the stock. I mean, why would you not want this? That's why you'll see in our top trade alerts, we pick AT&T a lot. Viacom too. I mean, Jesus, people. If you don't own Viacom, what on earth is wrong with you? Look at people today, they're selling it. It's unbelievable to me. $27 billion in market cap. They make $2.5 billion a year. They're paying they're paying $2.24 in dividends. 27? No, that can't be right. Is that right? It seems like too much. Stop, Viacom, stop. What on earth are they doing? VIAC. Are you guys really paying that much? No, it says 96. That would be kind of kooky. It just went ex-dividend too. So let's see what that looks like. They paid 24 cents. Yeah, okay, that makes a lot more sense. All right, anyway. So Viacom, going back. But still, they're paying $1, and $1 is nice out of 41, but it's not incredible, it's nice. But it's not about the dividend for Viacom, it's about the value. It's about the fact that their PE is basically 10. And this is a perfectly good growth stock. It makes 0 sense. I mean, the people like Netflix and don't like this. The people like Time Warner, which is AT&T. People like Time Warner and don't like Viacom. I don't get that. I really don't. It's essentially the same thing. I mean, obviously AT&T's got other stuff going on, but this is a huge broadcast organization, very, very undervalued. But, you know, this is one of those cases where you can set yourself up with a really good options trade. You don't need the dividend with Viacom. And if we looked at that, and yeah, of course we have it already. So, I mean, I'm not making a trade, but, you know, if you look at, if you go out to 2023, and let's say we think, look at this price. You can sell the $40 puts for $9.75. That's insane. That's going to net you in for $30. You can sell the $30 for $4.75 and then in for basically $25. But why would I do that? 30's fine. I'm thrilled to have this thing for 30. It's $12 below the current price. So if we constructed a Viacom trade, and let's say how much, here's the thing, you start off with this. How much Viacom do you really want to buy for $30? Do you want 1,000 shares? Do you want 500 shares? How many shares are you comfortable holding for $30? I certainly don't mind having 500 shares, which is $15,000. I can certainly spend $15,000 on Viacom. So that's free money to me. Okay, they're probably not going to go bankrupt. Their $30 is a very reasonable price. There's no reason to expect that their earnings are going to collapse completely and make 30 untenable. So I have no problem at all selling 5 contracts to buy, which would obligate me to buy 500 shares at about $30. And I'm going to get how much? Let's say it was even $9.60, whatever it is. It's going to be $4,800. So I'm going to get $4,800 for free. And all I'm doing is promising to own Viacom for 40, which would be net 30 something. And then I could say, okay, well, I could play it to go up, or I can be super conservative and pick up, here's the $30 calls are $16.35. And if I took those and I sold, that's the 30s. If I sell the 42s, no, I'd sell the 45s. So 45s are $9.50. So basically 16, what did we say? 16.35 for the 30s. The 45s are let's say it's $9.35, doesn't matter. So it's $7. So you're paying $7 for the 30-42 spread. Did I say 42 or 45? Sorry, 45. You're paying $7 for the 30-45 spread. So I've got $4,800, and that means I can buy 8 of those, right? That means I could buy 8 of those, and I've got a free transaction. 7 times 8? No, I'm sorry, not 8. 6 times 8. Yeah, 6 times 8. So I can buy 6 of them for a free transaction. Don't have to be free. I can spend a little bit of money, considering I'm buying $30 calls that are deeply in the money. So I could buy 6 of those calls. I could buy 12 of those calls for half the price, right? If I buy 12, what am I spending? I'm then spending $3.50 net. And I'm not going to do all the math, but trust me. I mean, if it was 7 for 6, obviously I'm spending $3.50 for 12, because I'm buying twice as many. I'm sorry, if it was 0 for 6 would be $3.50 for 12 on a $7 spread. Because half would be free, half for $7. And that would net, so in other words, you'd be 5 short of these and 12 long 30-45 spreads. Now, 12 long 30-45 spreads would pay $18,000 if it's successful. And all it has to do is get to 45. So, you know, the net cost would be, I think we said $4,800, right? Something like that. So the net cost would be about $4,800. The upside is whatever number I just said, is 15 times 10, $18,000. So, you know, it's got 100+% upside potential, and all Viacom has to do is hold 48. Now, if you want to get more aggressive and say, well, it should be 50, then you can start by looking at the 50 and say, okay, well, the 50 is at $8.20, $8.10, $8.20, whatever. And do I want a $15 spread? The 35s are only, they're not 14, but let's say let's say this is 13.75 and that's 8.25. So 8.25 plus 50 is 8.50 plus 5, right? So it'd be 5.50. So here it's 5.50 for the 35.50 spread. But I don't know. I don't know if I'd want to do that because you're saving yourself $1.50 per spread, but you're pushing your spread $5 higher in strike. So you have to get to 50 now instead of 45. I think I would rather do it the other way because frankly, you can make up the $1.50 by selling some short calls, and if you're comfortably in the money, you can sell out of the money short calls like the June 50s are $1. So if I sold a few of those, 3, let's say, remember we have 12 long, 5 short puts, 12 long calls. If we sold 3, which is 1/4 of the longs of the $50 short calls, that would generate $300 in 50 days, and we have 600 days to sell. So we could do 10 of those. And if we sell just, how many did I say we're going to sell? 3? If we sell 3 for 300 and we could sell 10 times that many over time, that means we can sell $3,000 worth of short calls. That pays for us to be deeper in the money by itself, right? That already pays for us to be deeper in the money. There's no reason for us to not be deeper in the money. But you see what that is? You have to think about the overall period you're going to be holding a stock, not just what is my goal this month, this quarter, whatever. You have to think long term and how you're going to do that and how you're going to pay for it. Joe Biden, 8:30, it says on the TV. He's going to talk at 8:30. So we'll see what he has to say. But taxes are going up. That's one thing he's definitely going to be saying. It's a way is how does he phrase it? How does he make it palatable to people? And you know, we're all such children because it's like we knew we didn't, well, we knew. I'm old, so I knew. You know, taxes don't go up forever. Don't go down forever. At some point, people raise taxes. We have been ignoring that fact for like 40 years. That you can't just lower taxes and lower taxes and lower taxes. And at some point, you have to balance your budget, and that's what Biden's trying to do. He's got these programs, he's trying to get stuff accomplished, but he's trying to do it in a revenue-neutral fashion. And part of that is because he wants to avoid a gigantic budget fight with the Republicans, but he still wants to get his stuff done. And that's why he's challenging them and say, if you have a better way to pay for this, let me know. And what he's also doing, which is smart, is he's avoiding military cuts, because that's something the Republicans will be able to freak out about and make it a big cause and blah, blah, blah. Even though they've raised the military like massively under, you know, even Trump, I think, went up like 10% or something on military spending. So, you know, at some point you might want to roll that back or at least stop increasing it. Even stop increasing it is a rollback practically the way we spend on military. And Biden's like, you know, hey, we're going to give social programs a chance for a change. And you know, but to pay for that, something's got to give, and so it's either got to be the military spending, which is massive, or it's going to have to be like the tax cuts, which are also massive. And if you want to balance your budget, one of those things has to go. The other items are non-discretionary, so the only discretionary item of any size is the military. And you know, yeah. I mean, you kind of have to think it's discretionary. There are countries that have like no military budget at all, and they're fine, like Japan. you know, and yeah, of course we have a rule, you know, we have a rule. We wrote their constitution and we said you can't have an army. They're kind of moving away from that now, but back after World War II, we rewrote their constitution and said you cannot have an army. U.S. government spending pie chart 2020. Ooh, that's an interesting looking one. What's that? Oh, I see. Spending and revenue. That's kind of cool. Where is that? Well, no. That was a cool chart. Oh, you tease. Oh, here it is. Okay. I was like, damn, that was a nice chart. Very nicely done. Good job, somebody. I was 219 though. But anyway, so here's Social Security, here's Medicare. Their entitlements, can't really touch them. Here's interest on the debt. This is where we can get killed. Here's defense. Here's the VA. You see what they do here? They have the DOD and they have the VA here, as if the veterans didn't come from the, as if the DOD had nothing to do with the veterans. So really, defense spending includes the VA. It's $858 billion. And when they talk about cutting stuff, it's crazy because, all right, here's your problem. Income tax, 1.7 trillion, payroll tax, $900 billion, Medicare, Medicaid is 282 coming in. So paying a lot more out than we're paying in. We're already very negative over there. It's also covered in the payroll taxes. Unemployment insurance is this teeny little thing here, which is, you know, obviously, think how much money we paid out in unemployment insurance. It's like we're not covering the real cost of unemployment insurance, if you want to call it that. Excise taxes, it says. Is there a plus sign here? No, I don't think it gets any bigger. Tariffs, estate, here's Trump's tariffs, 82 billion, it's a little sliver. Estate taxes, 17 billion that everybody freaks out about. And corporate taxes, here's the worst thing. Who makes these payrolls? Who pays this income? Think about it. The corporations pay the income. Payroll tax comes out of your check too, right? Payroll itself, not payroll tax, payroll is this, right? In most companies, payroll is less than, an airline is considered very payroll intensive, and 1/3 of their revenues goes towards employees. And most companies drop 20% to the bottom line, right? So in other words, most companies, their income is going to equal their the corporate income is going to be the same amount that they pay out in wages. Okay, just follow this logic. The tax on the wages is $2.6 trillion. That's the tax on the wages. So let's bring out Mr. Calculator and show you how this works. So the taxes, let's say, are 1/3, or let's even say they're let's say they're 1/3. I'm sorry. Instead of saying they're 1/4, it's probably 1/4, but let's say it's 1/3. So in other words, 1.7 plus 0.9 is $2.6 trillion. Now, times 3, that's $7.8 trillion. That's how much wages are paid by corporations. Any of you guys who's ever run a corporation knows that basically your profit should probably equal wages. That's a very, you know, generally you're going to be running a 20% profit. You're going to be paying 20% out in wages. But let's just say that wages are 1/3. So now we're going to divide that by, I'm sorry, so let's say wages. So that's the wages you pay out. So let's say that wages are 1/3 of your company's revenues for whatever reason, and let's say that actual profit is only 15%. instead of 33. It's not going to be matching wages. It's going to go the other way. Let's say you're an airline, basically, and you're only going to drop 15% to the bottom line. Well, that means we divide that by 2, and it's $4 trillion. Okay? So basically, corporate profits are $4 trillion. Yet corporations only pay $221 billion in taxes, 5%. At most, they pay 10%. At most. It's a huge problem. We have a balance, an imbalance of the budget of $1 trillion. If the corporations paid 25% flat tax, that would be $1 trillion. That would be 800 billion more. That would cut our deficit down to almost nothing. Then we could start looking at cutting a little here and a little here and a little here and making a difference enough to bring the budget in line. That's all it would take. Make corporations pay the proper amount of tax. But instead, the Republicans are always trying to lower the corporate tax even for, you can't go any lower than this. They're not paying taxes. They're basically not paying tax. And you know who pays these corporate taxes? Small companies pay the corporate tax. The big companies pay nothing. The small companies that get screwed. They're paying full boat. You know, they don't have a hundreds of $1 million accounting budget to get out of everything. So the problem is, and keep in mind this $800 billion that isn't being paid by the corporations is the reason we have over 30, 40 years of this crap. That's the reason we have the deficit we have now. That's the reason this number, we're paying interest on that. When every time they don't pay us $800 billion and it increases our deficit, we then have to pay interest on what they didn't pay us. But the serious danger of this whole thing is this number right here, because this number is based on a very artificially low bond rate that we're paying. 10-year notes, 2%. That's not normal. That's not normal at all. 10-year notes should be 4%, 6%. And if this number goes from 390 to this number, basically, if this section goes here at 6% and it's all red, all this would be interest on debt, what are you going to cut? Well, you can't cut the DOD. Yeah, you can't cut the VA. So somehow you would have to take all this extra money out of all these guys. That would leave you zero for all this stuff. This section here is about the same size as all this. So if the debt goes up and we don't cut the DOD and we don't cut the VA, then all this goes. If you want to try to, and that's to maintain a $1 trillion deficit, and that's assuming that the entitlement spending doesn't go up, but it is going up because the population is aging and getting larger. You know, this is reality, and this is math. This isn't like an opinion. This is how it works. And we have been ignoring the math since Clinton got voted out of office. Clinton balanced the budget. Clinton was extremely concerned about this. And everyone was concerned about this once upon a time. We were supposed to fix this. When the hell was he president? 2000. So 20-something years ago, we were very gung-ho to fix this because it was critical to our country to fix this. We went the other way. We said, fuck it. That's messed up. And that's why we're where we are today. But you can't really fix this. So how do we have to fix this? The only way to fix this is to increase this revenue to match this or decrease spending. But if you decrease, you not only cannot decrease spending because there's nothing left to cut here. These are untouchable. These are untouchable. This is untouchable. It is what it is. It's actually, and this is actually going to increase over time. You really can't cut anything. The only thing you can do is increase your revenue. And increasing revenue means obviously expanding the GDP, expanding the growth. So number one thing, so Biden's saying right now, he's saying, screw this. This is going up to here. This is going to become a bigger piece. We need to bring that in. This is going to get uncapped, and they're going to get more money from Medicare, Medicaid, and Social Security also. That's going to, these will have to increase by uncapping it for one thing, possibly increasing it slightly. They're going to have to do something to fix that also. But we have to get this number closer to this number. And also we have to grow the total economy so that this revenue number is bigger, but you have to do it in such a way that these costs don't go skyrocketing, that the cost of taking care of people doesn't go skyrocketing, that all these other costs don't go crazy. Very, very tricky stuff. But that's the situation we're in, and we need to like really be aware of this, because this is our future. And it's not the future we can kick down the road like we did 20 years ago. This is the road we kicked it down to. But like I said before, modern monetary theory says you can just keep funding the deficit forever. You can keep funding debt and just keep doing this until you basically it'll never stop. You just keep monetizing all your debt and having this endless cycle. I don't know if that's true. If they're wrong, we are totally screwed, because we're betting on that right now. We're betting that central banks can just keep printing money and nothing bad's going to happen. And it's not just us, it's every economy in the world doing it. And that's actually good. As long as everybody's doing it, then it works. If people stop doing it, by the way, that's what China with their alternate currency, and Russia also, who's putting more and more money into gold and trying to make they're trying to harden their currency so it's less like ours, less of a fiat made up bullshit on paper. So Russians trying to back a portion of their currency with gold to make it stronger, and China is digitizing their currency to create a sort of a Bitcoin out of the yuan. If they do that, we're in trouble, because by comparison, our currency is a joke. It's backed by nothing, and we print more of it every single day. Not a little either. I mean, we're printing hundreds of billions of dollars a month of new money. So I'm not bitching about spending or anything like that. It is what it is. But this is really not in. This is not in control at all. And these are the things that we have to deal with. These are the stuff that has to be justified. So we're going to hear Biden talking about that. Oh, the Fed, right? Where are we? Well, we know nothing happened. Nope. Fed statement. $120 billion QE pace continues while the Fed acknowledges the progress made since the last meeting via the sentence, amid progress on vaccinations and strong policy support, indicators of economic activity, employment have strengthened. Basically a boring statement. Well, yeah, that's what we expected. Transitory, they're still calling inflation transitory. Stock futures lower, treasury yields rise, blah, blah, blah. Let's see. My friends, Fed holds steady on notes. All right. So there's zero of surprise here at all. Oh, come on. Why did you lose my assignment? Here we go. The sectors most adversely affected by the pandemic remain weak, but have shown improvement. Inflation has risen, largely reflecting transitory factors. In other words, they think it's going to just go away. Interest rates are near zero still. Central bank is purchasing 80 billion of treasury bonds and 40 billion of mortgage-backed securities every month, 120 billion a month being thrown into the economy. Because in other words, who are they buying these bonds from? Who are they buying securities from? Buying the bonds from the treasury. So they're funding our debt. Though only funding $1 trillion worth of our debt, though. They're not funding all of our debt. And when they buy mortgage-backed securities, who are they buying that from? They're buying it from the banks. They're pushing money, $500 billion a year, they're pushing into the banks. That's a lot of freaking money. And who is the Fed? The Fed is the banks. The Fed's not the government, the Fed is the banks. That's what the Fed is. It's a bunch of banks. They get to print their own money. It's just such a funny thing. They said they'll hold rates steady until the labor market's back to full strength, which God knows what that is anymore. Powell says it's unlikely to materialize this year, so they're going to keep the easy money up. There's nothing exciting about this report, though, on the whole. Fed officials stress they want to see progress in unemployment data. We're just beginning to see good data. We're going to need repeated months of this before we can. So in other words, they're saying they don't care what the data looks like. They don't care how good things are. They don't care what's happening. They are still printing money and they are still throwing it into the economy, and they're not going to stop until you make them. And why are they not going to stop? Because they're bankers. They've got a button that says print money. You have to make them stop. They're not going to stop on their own. It's like they're printing money for their friends, for their own. They are bankers. They are not government officials. They are bankers. They are appointed by the banks. The president gets to choose the head of the Federal Reserve from the bankers that are presented to him. These people are put up by the banks. They work for the banks. They do not work for you, but they get to print US money and put it in the banks. And then theoretically, the bank's supposed to lend it to you. In reality, that's not actually happening unless you're rich. If you're rich, you can borrow money. If you're not rich, you're having a lot of trouble borrowing money. So now that we're post-Fed, there's no real improvement. We're nowhere. Nothing happened. The markets haven't changed. There's been no improvement. We're still waiting for Powell to speak, but as you can see, like nothing is happening. Well, that's Viacom. So nothing is happening, nothing's going on, nothing's changing. And we'll see what happens. So today, was it today or was it yesterday? I kind of made a couple of picks. I think it might have been yesterday. What did we talk about? Oh no, it wasn't today. Okay, so it must have been yesterday. All my days are running together because I don't go anywhere. I got to take a vacation just for the sake of it. Like it's got to get out of the house and do something. Getting my shot on Saturday, so I think I'm going to take a little break shortly after because I just need a couple of days to go somewhere else and do something else. Can't just do the same thing all the time. Aha. Oh, look how fast UBS is recovering. So, you know, we played UBS. We figured they wouldn't be too badly hit by the thing with what were they called? Archegos. And yeah, they took this was their earnings, so they tapped down to 15, but now they pop back up to 15.45 because they're a great bargain. And I reiterated this trade on UBS yesterday in the member chat room. And we targeted 15. As I said, that was my base, and that's where we wanted to be. Because, and again, that's why we play these things conservative. People say, why aren't you more aggressive? Why should I be more aggressive? This is a 2,750, and by the way, it was cheaper yesterday. This was losing money as of yesterday. That's a $2,750 on a $12,500 spread, $9,000 of upside. So like, almost 400% upside on this thing. I think it is 400%. So, or I'm sorry, 300% plus 300% to get on this thing. In 9 months, that's this year. This is a this year trade, January. So in 9 months, you can make 300% just betting UBS is going to hold 15. Why would I want to take a risk? And you could see, because we had that pullback, because we don't know for sure what the bank's going to do. We didn't know for sure that they weren't going to take a big hit. But yesterday they announced their earnings. They announced how much damage they had from Archegos. It turned out to be, I mean, you would think this is a big deal, but it was only 774 million. And that's nothing. That's not even $1 billion. And they make good money. It's a strong bank, and it'll wash out. And I think I said that somewhere. I must have said that. I know I thought it. Huh, I didn't say it. That's weird. I don't know. So I swear I said it to somebody at some point. But so the point is, here's the point though. The loss is not a big deal. Here's UBS's financials. So they got 53 billion in market cap. They lost $1 billion. They make in a typical year, here's their profits, 6,3,1,4,4,6, projecting 5 and 5. Okay, so they lost 20% of 1 year's profit. Not even, it's only 750 million. So they lost 15% of a year's profit, basically. And you have to think of it like if it's a one-time loss, and hopefully it is, right? But if it's a one-time loss and they lost $1 billion, then you take it over the next 5 years, you divide it by 5, so that's 200 million a year over 5 years is how they're going to pay it back. It's like a loan almost, right? It's a loss. It's a one-time loss that'll deal over time. So what is that going to do to them? It's certainly not going to take them down that much because it's only 5% of their total earnings. And meanwhile, this is a $50 billion bank that makes $5 billion a year. They're only trading at 10 times earnings. It's not like they're expensive in the first place. So, there's no reason to get out. There's no reason whatever. And that's how I felt. My cap was 10 times earnings, which is exactly where we are now at 15. So I figured they're going to definitely hold 10 times earnings. Eventually, once this is passed, some people are going to start looking for value stocks. They start getting back into the financials, and everything's hunky-dory. And if things pick up, they win. They win in the inflation game. That's good for them. So, where was I? So anyway, so the trade was to sell the $15 puts. That's the aggressive part. We're willing to buy 5,000 shares for $15. So that's $7,500. That's what we're committing to. 5,000. No, sorry, 75,000. We're committing to $75,000 worth of the stock. 5,000 shares times $15 is $75,000. We're getting paid $6,000 to make that commitment, but we feel very strongly that's where the value is on this stock. That then is totally free money. We put that towards this bull call spread, which is 250 times 5, which is 12,500 times 50, and that's 12,500. So it's a $12,500 spread. We're only paying $2,750 in cash, and we can make $9,750 in 9 months. What's our risk? What's our total risk? Our total risk is owning $75,000 worth of the stock. That's our risk. But is that the risk? Are we going to lose $75,000? Very, very unlikely. What if we lose $25,000? If it drops down to $10, then we'd be down $25,000. Could we work our way out of that? Of course we could. We sell some calls, we sell some puts, we double down, whatever. It would have to be catastrophically bad for us to really get hammered on this. So we're risking in a worst case imaginable scenario, and worst case imaginable doesn't mean imagine everything goes to zero. The worst case imaginable for, like, realistically, given what we think the world looks like today, what's kind of risk are we taking? Like, in other words, you cross the street, right? There's a worst case to that, isn't there? The worst case is you get hit by a car that you don't see and you die. That's your worst case. That doesn't mean you never cross the street, though, does it? You have to take reasonable risks in life to move forward. You have to go forward. When you go to get food, every time you take a bite of food, you could get some kind of botulism or poisoning or whatever. You're taking a risk. Everything you do is a risk. And people say, things like this. They look at it and go, "Oh no, you could own $75,000 worth of stock." I'm not risking $75,000. In no realistic terms am I risking $75,000. Could you lose $75,000? Of course you could. The same way I could die from eating a cookie, or more likely a piece of deli meat that's sitting in my fridge for too long, which I'll still eat. But it's like if I eat a piece of turkey that's been in my fridge for a week, I probably shouldn't eat that. I'm taking a risk that I might die. Will I die? 99 out of 100, not even 999 out of 1,000. I'm not going to die. Might get a stomach ache. Okay, 99 out of 100, I'm not even going to get a stomach ache. So will I eat that week-old turkey? Sure I will. Because I don't expect to actually get sick, and I want the turkey. End of story. It's the same thing when you take a risk on a stock. I'm not risking $75,000. Okay, this is like my mom telling me, don't wear a coat when you go outside in the rain. I'm like, Mom, I'm waterproof. I've taken showers. I've tested this theory. It doesn't kill me. So you take a reasonable risk on things. So when you're looking at the risk profile of your portfolio, and we put this in the LTP, which can totally afford this anyway, but I'm saying when you put your money in a portfolio, this is the kind of things you do use margin for, because you kind of say to yourself, okay, I don't care if there's a theoretical $75,000 risk on this trade. The reality is I very, very, very much doubt I'm going to lose more than $25,000. So you're risking $25,000 to make $9,750, but you're going to make that money in 9 months. So that turns it into a pretty good risk reward trade, even though a pessimist might say, oh, it's a $75,000 risk. I don't consider owning UBS to be a $75,000 risk. Now, it's not a freaking .com. It's not a momentum stock. It's not Tesla or something like that could easily drop 50%. It's a freaking bank. It's an institutional bank that's world renowned. You have to take that into account when you're looking at the risk profiles of your trades. Nomura is another one that we talked about yesterday. They don't have good options, so I didn't want to play them officially, but it's a damn good buy at 543. That's a great price for them. Here's 3M. They had disappointing. Well, they weren't disappointing, were they? No, they had a 20% beat on earnings and revenue. Oh, I know, because people don't consider that people don't think that they can keep this up. We have a target of 160 on our trade, so we don't care. Our target is way down here. And again, why? We took conservative numbers back in May 22nd, somewhere out here. We played this conservatively to go to 160. Probably it was around 160 when we did it. I did not plan for it to go higher. When I hit 210, we were just deeply, deeply in the money. Now it's coming back to 180. But we think it's going to hold 160 and probably bounce around and be a little bit higher by the end. Who cares? The reality is, who cares? All we need is 160 and we make all the money. How did this one work? 42 minus 30 is $12,000, and it is a 15 times 30 spread. It's a $45,000 spread that we bought for $12,000, and it's already at what is that? That's 42.41. So it's already at $41,000. It's only a $45,000 spread. So probably we should have cashed this out, but we never did. Oh, you know why we didn't cash it out though? Because it expires again. It expires in 9 months, and we saw no possible way that we were going to go back to 160 and lose money. So there's no reason to cash it out. It's even though we've only got $3,000 left to gain, we don't have anything better to do with the money. We can cash out 41,000 bucks, but what are we going to do with it? Just stick it in the pile with the rest of the cash. So there's no reason to cash it out. We're very comfortable with the valuation. Oh, I'm sorry, that's Lily. I'm sorry, that's not even 3M. That's Lily. He just happened to be close in things. 3M is at 192. I'm sorry, 3M does not have that problem, I don't think. Silly me. Nope, doing it again. Okay, same thing. Well, more so, obviously. This is what I'm talking about, 160. Look how insane that is. It's not coming back there. So there's no, so is it really worth it? Could we do something better with $45,000 and make $3,000 by the end of the year? Of course we could. But we don't really have anything. We're not dying to buy anything. We already have $1 million in cash sitting in the portfolio. If we had 1,041,000, it wouldn't really change anything. So we're just leaving it in there for now. But and again, that's when you talk about risk. Is this a risk? Do we consider this a risk? Are we worried that we're going to be forced to own 3M at 130 bucks a share when it's trading at 190? No, please, can I buy 3M for $130 a share? I would love that. It's not going to happen. But that, by the way, since that's not going to happen, we could totally leave that on the table, and that means we pretty much have $42,000 of value on the spread. So literally only $3,000 left to gain, and we leave the short puts because we could care less if we get a sign, because we'd really like to own it at that price. What else was fun? Okay, I like decom, but it didn't fit it for a portfolio. But decom, yeah. Here's oh, this is actually a good lesson. Decom merged with BDGE just at the end of last year. So their consolidated books don't start until 2021. In 2021, though, and starting with this quarter, they're going to be reporting consolidated earnings. So they're basically doubling revenue and tripling profits. That's basically the way this company is going to be working. Okay, and it's not a magic trick. There's nothing special going on. It's just that BDGE earns this much money and Decom earns this much money. Two small banks, two community banks, and they don't compete with each other particularly. They're near each other. They're just combining. So they can have a bigger upper management and better growth potential going forward. And strategically, BDGE wanted to have more branches going in that direction, and Decom wanted to have more branches heading in the other direction. So they were perfect for each other. They said, hey, let's not do any bullshit. Let's just merge the two companies, agree on a fair valuation for everybody, and share it. The weird thing they did, though, was they used Decom's symbol in the merger. Decom was a much smaller bank, half the size of BDGE. So the problem is, for the chart then, the Decom chart endures, the BDGE chart is gone, and the chart shows that Decom was an $18 company. So when it gets up to $30, $36, everybody's like, whoa, that's crazy for Decom. Chart people are idiots. Keep this in mind. Always remember that chart people are idiots. And they look at the chart and don't take any fundamentals into account. And the fundamentals we're taking into account are, this isn't the same company anymore. It's just a symbol. It's no longer this company. It's now the combined company. You have to look at the combined earnings, and the chart has to be an all-in chart. But this chart is still reflecting the old company and the old earnings. And they've got no idea where there's nothing here tells you what's going to happen. So this is a ridiculously undervalued stock. The problem is, they don't have, they're very thinly traded options. So I said, here, you know, I would do this, but I would just flat out buy these guys. This is a ridiculously, stupidly low price for these. NRG, we've discussed before. We already sold the puts in the long-term portfolio. We sold the $28 puts. And we made money on that already because when it crashed, when NRG crashed this part of the range, we determined it was a bargain down here. Doesn't mean it won't go lower. It just means that we're happy to pay this price. So we sold the $28 puts, which are way the hell down here, because look at the low over here, right? So we sold the $28 puts for $4.20, and we consider that free money. We're like, I don't care if it goes to 28, happy to buy it. So we sold 10 of those and collected $4,200. So now, as it's back down here again, we started the trade here, sold the $28 puts because we were like, if it gets to 28, we don't care, we'll buy it anyway. Turned out we bounced here. We didn't know it was going to bounce. It could have kept going lower, but it bounced. Came back down. We said, and what happened is, though, we missed our opportunity to add to the trade. We were kind of hoping it would just keep going lower and we would add over here. It didn't. It bounced, and now it's come back. And now that it's back here again, we're like not going to wait. We're going to start adding the bull call spread. We didn't have the confidence here to add it, but after seeing it hold 36, we have a little more confidence in it. Doesn't mean it's not going to go down to 32, but I don't want to wait again and get and be basically we weren't able to complete the trade because we always intended to add more. So now we're spending how much? We're spending $9,000. Don't forget we collected $4,200, so we're spending $9,000 on the long calls, the $30 calls for 9, so the $30 calls at 36 for 9. So we're paying $3 in premium for 10 of the calls. And of course, we're going to sell short calls, but not now because I want to see if it bounces off of 36. When would we panic and sell? What we would do is right now we'd like to sell the $45 calls, which are $3, way the frick up here. We'd like to sell these for $5 when this thing comes back up to 40. That would be our goal ideally, is to do that. Then it would be a really cheap spread because it would be 9 minus 5 is 4. It becomes 4,000, and we collected 4,200 to start, so we'd have a free trade with a $15,000 spread. So ideally, that's what we'd like to have happen. What if it doesn't happen? Well, if it doesn't happen, what's going to happen is, let's say it fails at 36, and then it fails this line here. I'd give it till this line probably. Let's say it fails 34. What would we do then? We would sell the $35 calls for probably $5, and we would take that $5 and roll the 30s down to the 20s, and then we would have a 20-30 instead of the 30-45 spread. So it's not even really a bad outcome. It's just different. But you got to think ahead of like what adjustment are you going to make and how are you going to do it. So if it goes further down, we're going to take these. We're going to spend $5 to roll them down $10, and we can do that. That's always available to you. So we'll spend $5 to roll these down $10, and then hopefully we can sell the $35 calls, and we're still above 35 now. We can sell those for $5 and offset the cost of the roll. And then we would be in the 20-35, 20 way down here, 20-35 bull call spread with the short $28 way down here with the short $28 puts for net zero. So why would I not want to make that trade? It's just crazy not to make that trade. This is the next logical step in the trade. There's not a tremendous downside to us doing this. And again, it goes back to the risk. Am I risking $9,000? No, I'm not really risking $9,000. I'm putting $9,000 down on the table, but I don't believe that I'm risking it because I feel the value is there. And my worst case is I'm going to be able to sell it, roll it, and reposition it before losing too much money. If you trade like that, if you plan out your trades and think about what you're doing, you can make huge returns on these things, just crazy amounts of money. Then we liked Future Fuel. Boy, we were busy yesterday, huh? Then we like future fuel. And we're putting that, we haven't put anything in the futures now probably for a while, but they're like a biodiesel company, specialty chemicals. And again, very good valuations. Really hard to find good valuations. Oh, Powell's talking, not saying anything helpful. So, you know, they have great margins. They're very small. They're $560 million, basically a penny stock, even though it's trading at 13 bucks, but it's a penny stock. And if you think about it, though, think of all the money Biden's throwing around on energy things. If it's just a teeny tiny amount of money finds its way into their company, if they get one little program that says, yes, you know, you guys qualify for this, their sales can really take off. So I like them a lot. I like them. They're a good value now, and they're nice. They're small. They're growing. They've got the right kind of thing. You've got the infrastructure program going in that they're going to benefit from that probably. And even if they don't, they're still got a nice little niche market where they're making huge amounts of money. So I'm saying let's promise to buy 1,000 shares of this for $12.50, which is lower than it is now, $12.50. We sell 10 November 1250 puts for 160. That means that $1,600 is free money. If I'm really willing to buy $12,500 worth of stock, 1,000 shares for 1250, then the $1,600 I'm getting paid for it is free. I'm getting paid to. I was going to do that anyway. It's like if somebody says, "I'll give you 10 bucks to eat lunch today." I was going to eat lunch anyway. It's free money. That's what free money is. I'm not changing my actions in any way, shape, or form. I want to own this stock. I would like to own it now. It is now $13. So if I promise to buy it for $12.50, what am I doing? Is it changing my action? As long as I really want to own it, this cannot hurt me. Selling these puts cannot harm me. It only is a benefit. I'm getting $1,600 to do something I wanted to do anyway. So our net would be 1090 that way, but you know, we're not really interested in that. We definitely don't mind owning for 1250. Don't forget futures now. We're looking at stocks that we think have a big future and will be good trades for the whole decade, not just trades for this year or next year. Since that's saving us, it's saving us $2,100. So if we get it signed at 1090, okay, that's $2,100 cheaper than we're willing to pay right now. I'm willing to pay $2,600. I'm sorry, 26,000. I'm willing to pay. No, I'm sorry. I'm willing to pay $13,000 for 1,000 shares. Which, by the way, is a teeny, you know, not, you know, smaller than an allocation unit for us. So, but I'm going to get it for 1090. So I'm saving $2,100. So I'm saying, since I'm saving $2,100 from the 13 I was happy to pay, then I'm basically taking the spread, which is a $2,400 spread, and it's essentially free. It's net $300 now for the whole thing. But now my upside is $3,750 on 1,000 shares, and all it has to do is hold 1250. I got the 10 1250 spread, and that's into November, not even December or January. That's November, so it's only, I don't know, what month is this? 5, 6, 7 months. So 7 months. So in 7 months, for promising to buy $13,000 worth of stock, I can make $3,750 on the spread, about 20% on the spread. But again, that's not my risk. I don't believe in any way, shape, or form this stock is going to be worth less than half of what it is. So I'm risking at most $6,000, $6,500 to make $3,750 in 7 months. I'm not risking $13,000 because I don't believe that there's any possible way this thing's going to go to zero. Could it happen? Sure, it could happen. We've had stocks that have done that to us. That logic has sent us to the grave on some stocks. But again, people do get hit by cars when they cross the street. You can't say you're never going to get hit by a car. You can't say you're never going to get food poisoning, but you have to take reasonable risks in life, especially if you want to get anywhere. So, and I said, we'll see how it goes on earnings. And as you can see, they seem to be, you know, today they're having a good day, but that's Sometimes that's our fault though, because we publish these things and then people start buying it, and we do tend to move the markets a little bit, especially on smaller stocks. So I wouldn't go crazy on it, but it's a nice off the radar stock and a really good value. I'm very, very into that one. And I said, yeah, so by the way, the FF trade makes 12.5 times, because it's only $300 net, right? So it's $37.50. Makes 12.5 times if the stock holds $12.50. I mean, what could be better than that? I only need the stock to hold $12.50, which is where it is, to make 12.5 times. I don't need an exciting market. I don't need an exciting stock. I need value. The options let me make value stocks exciting. That's the whole point of what we do here. I don't need to make crazy stocks more crazy. I need to make value stocks pay off like they're momentum stocks. That's the trick. And if we pick good values and we keep sensible about it, we're going to make a lot of money. And it's not complicated. This is basic, the same basics that we do all the time. Just a matter of picking your value, picking your spot, picking your time frames, and being realistic about when something is working and not working. And how do we know that? That goes back to how we track our positions, right? Here's a trade that's supposed to make us how much? I forgot. $37.50. So this trade is supposed to make us $3,400 by November. So I now have expectations for this trade. As long as the stock is at $12.50 or higher, then it's all premium that we sold. It's going to erode, right? In other words, the value at $12.50 is $37.50. That's a fact, right? If nothing happens and we stop at $12.50, and when these options expire, I get $3,750. So therefore, anytime it's at $12.50, the time decay should be the only factor, right? So if the time decay, so in other words, now I take my $3,400 in profit, I divide that by how many months, which we said is 7 months, right? So divided by 7 months. So let's call it $600 a month. So we should make about let's say 5. Sorry, because it's going to, of course, the premiums hold at the end. So let's say $500 a month. So this trade should make me $500 a month for the next 12 months. I'm sorry, for the next 7 months. And that's what we expect out of the trade. So when are we on track? We're on track if this net goes from 3 to 8 at the end of next month, we're on track. When it goes from 8 to 13, we're on track. What if it goes from 3 to 20? I'm sorry, from 3 to 2. If it goes to 2,000 in a month, that would mean the stock must have taken off, right? And we are unrealistically ahead of expectation. Even though we love the stock, we may say, you know what, this isn't worth the risk now because we made already, if it's 2,000, we would have made already $1,700. We made 5 times what we invested in a month. At a certain point, you're like, that, well, sir, we can't possibly make another 5 times. It's never going to happen. So then you have to evaluate, now I've got a $2,000 spread that can only make $1,700 more. Depending on how sure we are that we're going to stay on track, we might keep it, we might not. But it's all about every single trade. You have to have a plan, you have to have goals, you have to know where it's going to be, and you have to have an expectation of gain. If you're too far ahead, you might want to cash out. If you're too far behind, you have to recognize that pretty quickly and make an adjustment. How far behind can you let yourself go? Don't let yourself go more than 2 months behind. If you're 2 months behind as a rule of thumb, you should be adjusting your trade. So in other words, so now I know if I'm down $1,300, if I go from 300 minus 1,000 instead of plus 1,000 over 2 months, then I'm going to be minus $700. If I'm minus $700 on the spread, I got to think seriously about adjusting it because it's going to be hard to get back on track. 2 months from now, if I'm minus $700 on the spread, and it's a $37.50 spread, I've got to make up $4,400 in the next 5 months. So instead of needing $500 a month that I expected from the spread, I now need to make $900 a month in 5 months to get my money back. Not to get my money back, to get back to the profit I expected. So something would have gone terribly, terribly wrong if I'm that far off track. So if you're 2 months behind schedule, that's a big problem. But in other words, in this trade, flat is a winner, up is a winner, and down, in fact, I even said it here, our break even to get our 300 back is $11.55. So anything above, as long as we hold over 11.55, we're going to get our money back. And obviously you don't want to go to, I don't want to test that theory, but as you can see, 11.55 is pretty much the lows. So, you know, that's our break even would be way down here. That would be a real bad setback for this stock. So, you know, if they fall and it's a good reason and they terribly disappoint or something like that, then fine, then we get out. But also you have to think of the business. This is a niche little specialty chemical company, basically, that makes special biofuels and things like that. They're not very likely to have their business model upset. It's too boring. It's like we used to love playing Cleveland Cliffs because they don't, you know, they don't sell iron ore, they sell pellets. They sell little teeny pellets that are used in the manufacturing process. And those are great because nobody thinks about it, nobody cares, nobody watches them. And it's a great little business. And the advantage that they had is because these things are heavy. Cleveland Cliffs is the only remaining US manufacturer of these things. And so they had incredible shipping advantages over the Chinese competition. Even though they're more expensive, they had a great shipping advantage. So I used to love playing with those guys. Whatever happened to them? They merged. I think they merged or something happened that made us lose interest. I think they still exist as an independent stock, but I don't think they're the same company they used to be. And I never really got back into it. I haven't thought of them in ages. Yeah, see, they're still a thing. Damn, we used to play them like down here at the fives. Anyhow, so, you know, there's some really good trade ideas. Oh, we looked at Huntsman also. I had another one on Huntsman. That wasn't for portfolio? Nope, just a good trade idea. It's not blue, it wasn't for portfolio. There's no name portfolio. So here to do Huntsman also, and that's a nice little trade. 36.25 on a $7,500 spread. And again, I'll do that. You say, oh, only a double? I'll do that because it's only January. So it's already April, so it's actually May. So it's only 7 months away. So I think making 100% in 7 months is a worthwhile venture. You know, I know usually I try to make trades that make more money than that, but 100% in 7 months. And again, it's that kind of trade. What's our target here? $27. Oh no, I'm sorry, 30. Oh no, I'm sorry. Wait, I'm wrong. Our target is 27. We have the 22-27 spread. We sold the 25 puts down here. We have the 22-27 spread. So we're looking for staying above 27, which is over here. And we sold the $30 calls of June for an income because somebody is willing to pay us for, you know, 2 months, not even 2 months. Somebody's willing to pay us for June calls 95 cents. So we're saying, no, we don't really think it's going to go up 10% in June and burn us. And even if it does, we're only selling 1/3 of what we have long. So we'll be deeply in the money and in very good shape. And then we'd have to deal with the short calls. So I like that trade a lot. I don't know why I didn't put it in the portfolio. I think we didn't need it. I think that's why. It's another chemical company. I said it's another stupidly cheap chemical company. And people just don't pay attention to things like this. It's just, they're too boring and nobody cares, but these are great stocks. So you see, we're not playing right now. We're not really big on the Apple, Google, Microsoft kind of things. They're all so expensive. Ooh, look at that. The market's coming back nicely, actually. S&P, wow. I guess Powell's saying all the right stuff. Look at that. Look at that one. Ooh. Very nice. Wow. Russell up. That's a huge move. This is really impressive though. Look at this one. Holy cow. So this was the Fed. They were down here right at the Fed. And they popped up, went back down, and now they've decided everything is fantastic again. Powell says we haven't seen Powell said we haven't seen the level of scarring we were worried about. In other words, he's saying that he doesn't see we don't have lasting economic damage from the virus thing, from the lockdowns. It hasn't really been permanent damage done, and they were worried about more permanent damage. Now, I don't know if I agree with that. I walk around New York City, and other cities in Miami also, and there's a lot of closed stores, and I don't know how fast that stuff's coming back. I think there's a pretty big mismatch right now between the price of retail space and what retail people can afford. And I think we've already saturated the downtown cities with all the chain stores that can afford to throw money at these really expensive storefronts. And if there's less people in the downtown, it won't be worth it for them either. And the less people in downtown may be a lasting thing. You know, it's hard to say if a year of being at home is breaking people of a shopping habit. Maybe everyone's going to go out and shop with a vengeance. Who knows? But I don't know if I would make a statement like he's making right now. But Pal's basically saying, you know, we don't think the damage is bad. We think we're recovering nicely. Everything is great, but we're going to keep all the stimulus in place. That's what the market wants to hear, right? You don't need it, but here's a lot of cocaine. It's not for your health. Just have a good time. So that's where we are right now. All right, let's see. All right, can I answer questions and get out of here? Busy. All right. Since you. Oh, sorry. So Clay was saying something about the Viacom numbers. Oh, I see the dividend. Yeah, thanks. Neil says, what are your thoughts on the Dow? I think everything's overpriced. I think we're just being crazy about the valuations we're giving everybody right now. It's, you know, it's hard to, again, I wouldn't bet against it. We made a positive bet on the Dow for the short-term portfolio because we're sick of losing money, but that's where we are. Mitchell says, how should newer members begin? Obviously, we can't replicate the whole portfolio. No, don't do that. Yeah, when we have new trades and look what we just put in. We have the short-term, you want to the short-term portfolio you should be using proportionally to say, okay, some maybe 1/5 of your long-term portfolio should be in a short-term portfolio. And as you put the money to work, you put more short-term portfolio money to work proportionally, just to make sure you're going to be able to make money on the way down. And we're happy to talk about that in the chat for sure. That's a good lesson to always talk about. So I'm happy to go over that. And also, just like we just went over though, look at all those new stocks, right? Look at all the stuff that was from yesterday. It doesn't have to be, you don't have to have a portfolio full of blue chips. Blue chips are kind of expensive right now. We're picking bargain stocks. And it really is mostly about allocation strategies and portion sizing. And you have to learn that. That's important to learn. Obviously, read the education section, read the strategy section, and then ask questions about, especially portfolio sizing. I think that's something I should probably write an article about, because I think I have done that, and I don't know where it is. And, I don't mind going over that again, because that's real important stuff. And I should write a proper article on that, make sure we know where it is. But you just want to allocation blocks are the key to managing option strategies, because it keeps you from going crazy. It never seems like a lot, but then you realize like you over leverage and you over hedge. If you keep your leverage in mind, if you know exactly what you want to buy and you keep in mind your risk, then you know when to stop out and you know when to add things. And that's very important in all this stuff. Todd says CLF expects 4.5 billion this year. Holy crap. I got to look at them again. Remind me, because I used to love CLF and we just lost track of them. I kind of lost interest because they got so expensive. But maybe they're not expensive. Maybe they're just growing. So I always love them. It's a fantastic company. Can you review the WTRH trade? They compete with DoorDash. Oh, that's right. I like that one. We were talking about it the other day. When did we do that though? I don't remember. Was that Friday? Was it a top trade? I didn't make that a top trade, did I? Oh, I did. Haha, that's easy then. So Waiter, this is Waiter Holdings. This is WTRH, and we talked about them in our top trade alert on Thursday. And I love these. Look, I don't. It's not so much that I love the company. I love the fact that this is a $300 million company, and this is a $6 billion company, and this is a $46 billion company. So I only need them to gain traction and be recognized as a real competitor to these guys. They are the same companies. They do the same thing. These guys are much smaller, but they have 1,000 employees, and these guys have 3,000 employees. Now, notice nobody's covering it. Very few Wall Street analysts are paying attention to them. I think this is a nice little gem. Because if the thing is, if they don't work out, they don't work out. Okay. And we're taking a 2-4 spread. Where is that? So we're taking a 2-4 spread. They're at 250. And I think you can make a case for this thing. Okay, this is a startup, basically. You're investing in a startup. They're very small, but they're well-funded startup that can afford to have 1,000 people running around beginning to build a business. So in other words, they're getting themselves a presence in the market. And they just bought, the reason they came to my attention is we have a company, a local, there's many local competitors for all these guys. And in this particular area where I am, in the Palm Beach County area in Florida, they have a thing called Delivery Dudes. Delivery Dudes is just basically a regular old service. They're the best one of all the mini services there are in this area. They are the best one. They are a very nice website, very well organized, good clean thing, good concept, and everything else like that. These guys bought them, and that's what they're doing. They're acquiring existing companies. So they're going to grow their revenues very fast and suddenly, because all those revenues are going to accrete to where they are now. And so the number of employees grows quickly, the drivers grow quickly, but they've already got these local companies already have restaurants signed up, they already have drivers signed up, they already have customer bases that utilize them. So then you take that, and then they start putting money into advertising in a way that Delivery Dudes never could afford to, and scale themselves up on a national basis. They create a consolidated website that uses Delivery Dudes. Even though Delivery Dude says they're not going to change their name, these guys will have one consolidated national website to bring all their people together the way Grubhub and DoorDash do. And I don't think they'll keep the local brands forever, but they'll probably transition out of them as their own name, as Waiter becomes a more well-known brand. But the reality is, though, it's my daughter works for DoorDash. She loves it. She makes $100-$200 in a night running around like she's in college. And whenever she wants money, she gets in a car and starts driving around listening to music and delivering food. She loves that job. So she's one of these 3,800 people. Actually, I'm not even sure they consider that an employee. I don't know what the rule is these days. But anyway, so these guys are very well poised to be competitive. They're well funded, and they're making good choices. They're doing what I would do, which is basically just let's buy 20 or 30 or 40 of these local guys so that we have a footprint and grow from those footprints. Like then we've got the capitalization to go out and get into that market and grab a share. And again, don't care. They're not losing money. They're not bleeding a lot of capital. They are losing some money, but they're not bleeding a lot of capital. So they'll be able to do this for a while, and all they have to do is gain a little bit of traction and get recognized in this realm. And all of a sudden, this $3 billion will seem like it's still a bargain, right? If they're $1 billion and this is $7 billion, this is $42 billion, you're still going to go, oh, I know who they are, and they're only $1 billion. Well, that's up 3 times from where they are now. So this spread, we took it for $1,500 credit because we aggressively sold the puts. We sold the 350 puts. That means I expect this thing to basically go up a lot. It's 250 now. So I expect this thing to go up 40% at least over the next 2 years. I think it's probably going to double or triple because all they have to do is gain a little bit of traction. Meanwhile, this spread, we got a $1,500 credit for the spread. It's going to pay $10,000 at $4. So our target is 4. That's an aggressive spread, and that's in our futures now portfolio. But that one's a nice aggressive spread. But look at how much money it makes, 766% return on your money. All right, so that's how you play something new if you want to do it. And by the way, what's the downside? The downside is we own 2,000 shares for $350. So we're betting $7,000. So the worst case scenario, and I'm sorry, we're not even doing that because we're going to get a $1,500 credit. So we're betting $5,500 because we have a $1,500 credit. So we're betting $5,500 on 2,000 shares. So $275 a share is our worst case. They're $250 now. And we would end up owning 2,000 shares for $275, which is what, $5,500 or something like that. So yeah, so $5,500. Oh, I wrote that. I didn't even realize I wrote that. So worst case is we own them for $5,500. So our risk on this is $5,500. We can make $11,500 if it goes well. And if it doesn't go well, we own them at this price. Using the options doesn't add anything to our risk of buying the stock. Not at all. Yet it gives us a tremendous upside potential at a very small change in price. That's what's great about this stuff. Oh, all right. Well, that's a good way to leave things. And I'm running out of voice. And it is 3 o'clock anyway. All right. So thank you all for coming. It's been fun, and we will do it again next week. All right. Take care of yourself, everybody.